You want to get into real estate investing, but you don't know how you're going to be able to qualify for multiple mortgages. Well, I qualified for 3 mortgages on 3 houses in 3 consecutive years while keeping each one of them. So I'm going to break down exactly how I did it so you can do it too. And while explaining how I did it, I will tell you the 5 vital things that you need to do to be able to qualify for multiple mortgages. All right, for me, so I actually qualified for my first house. This is one that I just ended up buying and living in, and it had a studio apartment with it that I ended up converting to an Airbnb for rental income. Now, to be able to qualify for that first house, I obviously needed to have a good credit score. A good credit score is vital. It's one of the 5 vital things that I mentioned before, and I will put right here the things that break down your credit score. If you can improve on any of those things, do it, because it'll get a bump in your score and it'll help you qualify for debt. Typically, when banks loan to you, they want to see a debt to income ratio of no more than 36%. Now, sometimes they will go higher than that. I've seen some banks go up clear up to like 45% on a debt to income ratio. But typically they like to see 36% or less. So on this first house, I bought it for $185,000, but I put a good chunk of money down. So I financed $135,500. Now, my income at the time was $70,000. So my monthly gross income was right around $5,800, while my mortgage was right around $840. All right, I didn't have any other debt. So my only debt was the mortgage. That was $840 a month. My gross income is $5,800. So if you take $840 divided by $5,800, my debt to income ratio was 14%, and that is way lower than the 36% that banks were comfortable with. So vital thing number 2 is have a very low debt to income ratio. If you have other debt, get rid of it, because then that'll help you be able to qualify for more from a bank. If you haven't done so already, remember to hit that subscribe button to learn more real estate investing tips. Now, I should put a caveat right now. I do not suggest going into unrealistic debt, even if it's involved in real estate investing. And I love real estate investing. Like I said, I am leveraged on 3 different houses. Just be smart with it. Don't go into debt that you can't afford. Don't go into debt on a real estate investment that your rent isn't going to cover. So make sure you're smart with your debt. Now, typically in other videos too, I say you should never have more than 28% of your gross income go towards housing. Mine on this first house was only 14%, so I was well below that. Now, banks will even go a lot higher. They'll go to 36%, but keep it low, keep it as low as possible, because this is going to give you the ability to go and get more debt to finance a real estate investment. All right, on this first house, I had a studio apartment that I converted to an Airbnb, and this was very important because I started making $800 a month net of my expenses on this Airbnb, and it helped me go to my next venture. Now, this Airbnb was important because it is passive income. So that would be my vital thing. Number 3 is go find passive income, because it'll increase your income and you'll be able to maintain a low debt to income ratio because you have increased income. Now, I would suggest if you have other debt, like if you have car debt or if you have credit card debt, pay all of those down as quickly as possible, because that will help with your debt to income ratio as well. All right, the second house that I financed, I actually went a little bit of a non-traditional route. So I didn't go to a traditional mortgage. I actually bought the house and then I used a HELOC to finance it. HELOC is a home equity line of credit. This house was actually a rental and it already had a tenant in it with an existing lease agreement. So I bought the house, kept the tenant, and the lease agreement converted over to my name. So now they were paying me rent. All right, house number 2 was making me $800 a month in rent net of any expenses that I had. Now, this was important because it boosts my income. Also, for my job, I had increased from $70,000 up to $80,000 a year. So my income had increased there as well. So with an $80,000 salary, $800 a month from Airbnb, and $800 a month from this long-term rental that I just bought, my income was just north of $99,000. I still had the $840 mortgage from house number 1, and the mortgage, even though it is a HELOC, so I just pay interest on this portion right now, the debt load on that was like $230 a month. So my monthly debt was around $1,070. And my monthly gross income was right around $8,300. So my debt to income ratio was only 13%. which is still significantly lower than banks are comfortable with. So they had no problem giving me this HELOC on this second house because I had enough income. So making sure that you have a job where you have wage increases on an annual basis, opportunities to grow, all of that is very, very vital. I'd say that's the number 4 vital thing, is just increase your income over time, because if you increase your income, then your debt to income ratio will shrink, and thus banks will be more comfortable lending you additional money. All right, now I jumped to house number 3 and I went to a traditional mortgage and I financed just over $198,000 on this house. When I bought this house, I bought it for the intention of moving my family there, and then the house that I was originally living in, house number 1, I converted it to a long-term rental. Now by this point, I had worked hard in my job and my gross income for my job, my salary was $100,000, and I still had that $800 a month from Airbnb and $800 a month from the long-term rental. Now I was gonna charge $1,500 a month for the house that I was living in. The good thing is though, is because my income had increased and my debt to income ratio after factoring in all 3 of these mortgages was still below the 36% that banks were comfortable with. I didn't even have to prove that I had a tenant in there. I proved my Airbnb income, the tenant for house number 2, and then my current income, and they approved me for a loan. So the math real quick, I still had the $840 mortgage on house number 1, I still had $240 on house number 2, and I had $1,065 on house number 3. That was all of my debt. Now my monthly gross income was just above $9,900. Break that down, debt $2,100, $2,150 divided by $9,900. I still have an extremely low debt to income ratio. It comes in at less than 22%. So the vital thing number 5 is just being able to prove income. So if you can prove income, especially if you go and buy a rental property and it already has a tenant in it, or you have a property that you're looking for and you can show that you have a tenant lined up, that's going to help you significantly, because that's going to increase your income that your bank is going to look at when they calculate your debt to income ratio. So have proof of income. Now you may be saying like, man, but it's a lot harder now when interest rates are so high. And I agree with you. I haven't bought any houses in a little bit, which is a bummer because I want to keep buying real estate investments, especially smart ones. So it is tougher, but keep looking, look for the right deal. Now you do have the opportunity to refinance in the future if rates go down, which the Federal Reserve is signaling rate cuts at the end of 2024 and throughout 2025. That should help as far as financing costs go. Keep looking, keep grinding, and find those good deals. Thanks for watching, and we'll catch you guys next time.